If you've recently inherited an IRA, listen closely. There's a hidden tax trap buried in the Secure Act. It's called the 10-year rule, and the risk is a giant tax bomb.
Most people used to stretch inherited IRAs over their lifetime. Since the Secure Act passed, that's gone. Now, in most cases, you must empty the entire account within 10 years, with very few exceptions. And if you wait,
taxes will be brutal. Join us as we break down the hidden 10-year RMD rule.
Today's episode is brought to you by Security Financial Management.
Welcome back to Best Advice Podcast, guys. I'm your host, Rob Lavalio, here with Senior Advisor from Security Financial Management and Daniel Corson. What's cracking, baby?
it is the end of summer break.
It is.
School starts Monday, at least for my kids.
Yeah. Is that exciting? I mean, you get so much babysitting time, I guess.
Right.
You're my little pumpkin pop.
Right, I can get on a more routine schedule.
Yes, that's what I'm looking for.
Not looking forward to all the homework and that aspect. By now, they're at the age where they're pretty self-sufficient on homework.
Yeah. We're on a roll here. This is
Yes.
3 weeks in a row, baby. Let's keep it going.
3 weeks in a row of three-letter acronyms.
Yes.
We have the DAF, the NUA,
NUA,
and now RMD.
And now R&D. Let's get right to it. Today's question comes from Alex from Scottsdale, Arizona. Alex, what you got for us?
I just inherited an IRA from my dad. I don't need the money right away. Should I wait or take it now?
Thank you, Alex. Great question. The IRA typically gives you 10 years to withdraw all the money, but when you take it, it can make or break your tax bill. Dan, can we walk through an example or situation here?
Yeah, we worked with a woman who inherited $1 million from her father. Her initial plan was to wait until year 10 and take it all out at once, but that would have meant a massive tax hit, potentially pushing her to the highest tax bracket. Instead, we created a plan to spread withdrawals out over 10 years. By taking roughly $100,000 per year, she stayed in a more manageable tax bracket and ultimately saved over $90,000 in taxes just by having a strategy.
Pretty good. Pretty good. Well, let's break it down. So let's say you inherited a $1 million IRA, right? The option one would be to wait and withdraw everything in year 10, which would have pushed you into the highest tax bracket of 37% or even more. Now, the tax bill could have been over $370,000 in that situation.
That's assuming no growth.
Absolutely. Now, option two would be if you withdrawed $100,000 per year over those 10 years. That would keep you in that 24% to 32% tax bracket. And your final tax bill would be around $280,000, which means that tax savings would be about $90,000.
It's a lot.
It's a lot. It's a lot.
Exactly. This was the daughter of a client who passed, a young realtor whose income varied year by year. They gave us some flexibility. Depending on how much she earned each year, we coached her to withdraw just enough from the inherited IRA to maximize the lowest available tax bracket.
Okay, so in layman terms, for us who are not advisors, let's say in year 2024, the 24% tax brackets started at $100,525. And that is for single filers. So if she was on pace to earn, let's say, $45,000 in ordinary income from her work that year, you could advise her to withdraw around $65,000 from that inherited IRA. So her total income stayed just under that $100,525 threshold, thus avoiding spilling into a higher tax bracket.
In layman's terms, yes, that's the idea. Taking smaller withdrawals annually means only part of it gets taxed each year, which keeps her in a lower tax bracket and saves significantly on taxes.
So is there ever a situation where like waiting till that 10th year, year 10 to pull it all out is the right move?
Absolutely. Every situation is different and should be tailored to the individual. For example, I might recommend waiting in cases where, let's say someone is in a very high tax bracket now, but expects low or no income in a future year, like during a sabbatical, gap year, or early retirement. Or they're planning a large charitable donation or have offsetting deductions like business losses or carry forward tax credits. Or even if they want to coordinate with Roth conversions or other strategic tax moves. But for the circumstances we've already discussed, that particular client was a realtor with fluctuating income. The best strategy was to withdraw as much as possible each year without jumping to a higher tax bracket. That way, she got to let the account grow, avoid a tax spike, and save over $90,000 in taxes.
Well, I hope that helps, Alex. Inheriting money is great, but having a plan can ensure that you keep it. If you want to talk to Dan or any of our advisors here at Security Financial Management, we'll leave a link in the description. Give us a call. We'd love to talk to you. Remember, folks, the secret to wealth is not what you earn.
It's what you keep.
It's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.